Hello? Can you hear me? Yeah, hello, can you hear me? For those of you here on Zoom, can you hear me? Jemima, can you hear me? It's like you are speaking, but I still cannot hear you. More or less like your microphone is not connected well. Yes, your mic is now connecting, so wait a little bit. Beaming. Grace, your network is still very bad, so it's breaking that way. Jemima, can you hear me now? Jemima, can you hear me? Your mic is off, so you are speaking, but I can't hear you.
Yeah, please, can you hear me?
Yes, I can hear you. Grace, your network is still bad, so I hardly hear you in relation to that. So you are welcome to the live stream today, live Q&A session. We are also streaming this on YouTube. So for those of you who are here on the Zoom call, and you have a background that you don't want to be, please indicate in that, so that you don't show the public things you don't want them to see, because we are streaming on YouTube in relation to that.
Can you hear me now?
Yes, I can hear you.
We can hear you.
I'm not doing anything, so I decided to.
Okay.
Okay.
Right, so this is a Q&A session. You can bring up, come in a moment. So if you're watching on YouTube, you can bring up your questions, whatever questions you have, you can bring them up.
You can hear me?
Yes, I can hear you now. So whatever questions you have on YouTube, for those of you watching on YouTube, you can comment in the chat box with your questions. In case you want to join the meeting as well and speak to me directly also, let me see if I can put the meeting ID on the YouTube live chat so that you can see that in relation to that. So the meeting ID for YouTube, if you want to join, it's 883-771-9414. So the meeting ID is in the chat box for those of you watching on YouTube who want to on the call in relation. Okay, so like I mentioned yesterday on my live stream in relation to that, there's a Q&A session that I want to hold and answer any questions that you are having in relation to that and provide you with some strategies in that case. Like I said, we are streaming as well on the YouTube channel. So for those of you on Zoom call here, I'll be taking your questions and then I will also be reading the comments in the chat box on the YouTube channel so that we will be able to get everybody's question to come on board in relation to that. So let's begin the discussion real quick. Any questions for me, drop it and hit me with it, and then let's see what we can do in relation to that. So Bimi Senior, what are you writing? What subject are you writing? And what questions do you have for me today? That is, if you have one in relation to that, before I get into my discussion with you. Okay. Like this. Okay. Okay, Jemima, I have stopped your video in a moment. So if you settle down, you can turn on your video again if you want to set it on, because I realized that you were moving in and so I've stopped your video in a moment. If you get settled, you can turn it on back so that. Okay, so on YouTube, Iwe Kobala Seiram Edmond said, please, the meeting ID on YouTube isn't showing on the comment section. Please, the meeting ID is in the chat box. Where you commented, just look below. The meeting ID is there. 883-777-19414. So that is the meeting ID. Edmond Seiram, that's the meeting ID. I've put it there again, so you can join and then you ask your questions in relation to that. Okay, so I started with this sessions in relation to this about 3 days ago on my Facebook page, and I realized that in the last week Sunday we also held a Q&A session on Zoom like this, which we were streaming as well on the YouTube channel to reach the other audience, and we realized that it was something that was helpful to the students. So I decided that I will come on again today, and tomorrow too we will have another Zoom session at 10 a.m. Details of that will be posted or shared as well, respectively, in relation to that. So today also I want to continue with the discussions with you, and most importantly, provide you with some strategies, some techniques, and any specific questions you have on the various things you are studying. You can hit me with them, and I can assist you and answer those questions for you in relation to that. So for those of you who are on Zoom, if you have any questions, you can unmute your mic and then bring it up so that we can go on in relation to that. All of you, your mics are currently off, so you can unmute it and then you can ask your questions, and then we get a discussion going in relation to that. For those of you watching on YouTube, you can comment in the chat box with your questions, and I'm going to be addressing all of them as well on the live stream for you.
Hello.
Yeah, Jemima.
Yes, I asked a question on yesterday
Mm-hmm.
about the industry and the rates. You were talking about if we are computing the tax for the corporate entity, we have to check the location and the industry the company is in. So I wanted more
understanding on that.
Yes, about that.
Okay. So let me see if I can provide you with some things in relation to that.
Okay.
So let's see. So very importantly, when you're dealing with corporate tax liabilities, you have to take into consideration the location of the company as well as the industry that the company is in. And I made mention of the fact that when it comes to location, there are what we call location incentive or location tax rates that are used. So for instance, Accra and Tema is 25%. So if you are calculating corporate tax liability and the company is located in Accra or in Tema, the rate applicable is 22%, sorry, 25%. And then if the company, for instance, is also located in other regional capital that is outside Accra and Tema, that is 18.75%. And then district capital is 12.5% in relation to that. So something like Wasa or any district capital in relation to that. So that is what we mean by the location incentive in relation to that. Then also we can talk about incentives relating to the kind of industry that the company itself is operating in. Let me see if I could get that from my book here for you. Some of the rates in relation to that. Withholding tax, okay. Life insurance, fiscal policy, corporate tax liability company, okay. Then another thing also about corporate tax liability is about mining. For principle of tax, mining and natural resources is not in your syllabus, but for mining and upstream operation business, the tax rate is 35% in relation to that. So that is also another tax rate issue that we can talk about in relation to that. So let me see another slide here. To see if I could come up with the rates here. Okay, so basically these are some of the rates that we can talk about. Hotel industry, hotel companies, I think that is 22% of the rates. Listed companies also, I think 22 or 25% of the rates. Some of those rates, I cannot just come up with them off head, but these are all the rates available in relation to that. So, and then free zone companies, the rates are different in relation to that. So in a nutshell, what we're saying here is that once you are given a corporate tax liability question, you don't just solve the question. You are going to be dealing with the thing capitalization, financial gain, financial loss, all of those things. You're going to be dealing with that. But at the end of the day, when you are calculating the corporate tax of the company, you must make sure that you are taking into consideration the industry that the company is in, the location the company is in. Then, for instance, if the owner of the business is below 28 years, you know, entrepreneurs have that tax rebate on entrepreneurs in relation to that. So that is also going to be considered in that case. So Jemima, that is the issue about the industry and the location. The list is actually endless, but these are a couple of things that I can bring up in relation to that. All right, so Ebenezer and then Bima, if you have any question. Yeah, Bima, your mic, you unmuted your mic, you can go. If you have any questions. Beamy Senior. Beamy Senior said, can internally generated goodwill be recognized on the statement of financial position? No, Beamy, internally generated goodwill cannot be recognized because it is against the principle under IAS 38, intangible assets. IAS 38 prohibits entities from recognizing internally generated goodwill. Only goodwill that comes as a result of purchases or acquisitions that will be allowed to be included on the face of the financial statement. So, Beamy Senior, that is the answer to your question in relation to that. So it is not allowable, it is not treated for tax purposes in that case. All right. Any other questions? If you are watching on the YouTube channel, you comment below with a chat in the chat box with your questions, and I'm going to be answering all of your questions as well there in relation to that.
Okay. So another question.
Okay.
Yes, please, with convertible debt, at redemption, you could either redeem it at par value or at par premium, if I'm not wrong. So I would like, that's in FM, I would like to see the way it's treated in FM and how it's also recognized in the financial statement. That's IFRS 9 or something. If you could relate both FM and FR.
Okay, so let me grab my notepad so I can illustrate that to you. So yes, it's true when it comes to the treatment of convertible loan notes. There are actually three things that can happen on convertible loan notes. Number one, at the date of conversion, the bondholders may redeem their money. That is in financial management. I'm coming from financial management first. So from the financial management perspective or the financial management school of thought, what happens is that when the investors realize that the redeemable of the loan note is more than the value of the redeemable of the loan note is more than the value of the shares, then they will rather redeem their loan notes and get their money in relation to that. Give me a moment. Let me connect my notepad real quick so I can write. Eight eight three 771 9414. So we go. Uh-oh. Invalid meeting ID. Why? 883-7771 9414. Okay, so I'm connected now. Let me just share my screen with you. Okay. So if we have, for instance, a loan note and the loan note is redeemable in 5 years' time, like I mentioned, on redemption, three things can happen. Either the loan will be redeemed, or because you are talking about convertible loan notes, it will be converted. Now, in financial management, the decision on conversion will be made by comparing the amount for redeeming with the value of the shares on conversion. So if the company or the investors realize that maybe they are redeeming the loan notes, and if they redeem, they will get like $1,200 or $2,000. But if they convert it into shares, they may get a value of, say, $3,000. What is they are going to be doing is that they will rather convert it into what? The shares. However, the opposite is true. If they realize that the redemption amount is more than the conversion amount, then they will rather what? Redeem their loan notes. That is the financial management perspective. But in the IFRS 9, what happens is that it depends on what the shareholders do for us to account for it. So if, for instance, that is in full IFRS 9, what happens in IFRS 9 is that, number one, we need to determine how we can segregate the debt into the debt component and then the equity component. Because anytime there is that convertible loan note, we must separate it into the debt component and then the equity component. So in IFRS 9, the treatment is going to be different. Now, if we are getting the debt component, what do? The debt component is calculated by number one, calculating or discounting the cash flow. So we find the present value of the cash flows on the debt, discounting at the interest rate of similar bonds without conversion rate. That will give us the debt component. Once we get the debt component, we subtract the debt component from the proceeds, and that will give us the equity component. So the equity component equals the proceeds we get from the issue of the convertible loan notes minus the debt component, which we got in the step one in relation to that. Then all the time, when companies issue loan notes, they may incur issue cost. So if they incur issue cost, what happens is that the issue cost must be deducted from the loan notes. So because it is now divided into two, the debt component and the equity component, the issue cost would have to also be deducted using the values we had from this. So let's say that the total proceeds we had was, say, 20,000. And from our calculation, we did our workings and we realized that the present value of the cash flows on the debt discounted at the interest rate of similar bonds without conversion rights. This is very important. It's, let's say, 17,200. That means our equity component is going to be 2,800. So if this is it, now the proceed is 20,000, so we deduct the 17,200 from the 20,000 to get the equity component. Now, once we have the equity component, let's say that the issue cost we incurred on this issue, it's say maybe $1,500. So this 1,500 will be deducted from both the debt component as well as what? The equity component using the values we have obtained here. So for the debt, how do we do? We will say 17,200 divided by 20,000, okay, times the 1,500. That's how we get the value to be deducted from the debt. Then for the equity, we do 2,800 divided by 20,000 times the 1,500, and we will get for the equity component. Then we will deduct. Once we deduct these, we now get the fair value of the debt and the fair value of the equity. So that is the initial recognition. Now, on subsequent measurement, what is going to be happening is that the debt value we get will be carried at the amortized cost schedule. So we will do the amortized cost schedule to get the interest component and then the amount that will be taken to the statement of financial position. Now to your question which you asked in relation to what happens on redemption. So to your question on what happens on redemption. So on redemption, shareholders or the bondholders may decide to, among other things, do only two things here. Either they will take their money away or they convert it into shares. Either they are going to be taking their money away or they convert it into shares. But you got to be careful in relation to that. At the date of conversion, the value of the debt will be the same as how much you owe them. So if the debt you issued was $20,000, then on the date of conversion, you need to pay them what? The $20,000. Now, if they decide to take their money, this is where the entry is very critical. If they decide to take their money, how much are we going to be paying them? We will pay them the nominal value of the loan notes. But remember, redemption can be done at par, redemption can be done at premium, or redemption can be done at a discount. I believe you know these already, so I don't have to take you through them already. But whatever redemption it is, we get the amount of redemption. Now, if they redeem, we will pay them the 20,000. That is how much we owe them. But remember, if they redeem, we have had an equity figure here. That equity figure will be reclassified in the financial statement of the company as undistributable reserves. Undistributable reserve. So it is only the debt component that is going to be canceled using how much money we owe them. Then the equity component will be reclassified in the financial statement as undistributable reserve. This is what we do if they redeem the money. If they redeem the money. But if they convert it into shares, then what we do is that we must calculate the value of the shares and compare it with how much we owe them plus how much is in the equity. So that at the end of the day, we will divide that into share capital and share premium. So we will use the nominal value of the share price to account for how much must go to the share capital. Then the other balance will be going to the share premium in relation to that. So this is how we do the treatment in IFRS 9, that is in financial reporting, and then in financial management. Jemima, are you okay?
Yes, so please, if I heard you clear, then you were saying with a redemption, you could either redeem it at par, premium, or discount.
Yeah.
And that when it's redeemed, that means you must reclassify the equity component to, I didn't hear that part, but.
You must reclassify the equity component as undistributable reserves.
Oh, okay.
Yeah, hello. So this is on how do we call it? On YouTube. I'm just taking some things on YouTube. David Emirem, what's the session about? The session is about Q&A. So I'm answering questions that you have. And then Erasa is asking meeting ID. I've posted the meeting ID Erasa on the chat box, so you can copy and join. If you cannot join also, you can comment in the chat box with your questions. I'll be reading your questions as well here on the YouTube channel, and I'll be answering your questions as well in relation to that. Who else has any question for me here on Zoom? Ebenezer, Bimi, Aite, you are now connecting your sound, so I guess you will not be able to hear me well. Okay, Ebenezer, you can go.
Yeah, I was going through your book.
Okay.
On page 34. The question there on impairment, yeah. FR, financial reporting.
Okay.
Yeah, page 34. There's a question there. Can you get access to it? So I can.
Yes, I should be able to get access. That is the ebook, right? Ebenezer, are you talking about a question kit or?
No, the book itself. The book itself.
Okay. Page 34. Let's see what we got there. Yes, I'm there.
Yeah. That if you look at it, the question says that the asset was acquired on the 1st January 2014. And then the revaluation was done
this is about testing for impairment.
Impairment, yes. Yes. And on December 31st, 2019, the government embarked on a plan to construct a flyover.
Yeah.
And in your solution, because from 2014 to 2019 is 6 years.
Okay, so let's see.
The solution.
On 1st January 2001, 20x4, from on the 1st December 2009, the government embarked on a flyover to plan to construct a flyover adjacent to the building, and this decreased the access to the building, reducing the value of the building. The company estimated that it can sell the building for 1 million, paying 50,000 in cost. Alternatively, if it continues to use this, okay. So from January 2004 to 2009, it's 6 years. Yes.
Yes. But in this, in the solution, you made it 5 years.
Yeah, this is it. You realize that in the solution, we put the 1st January 2005. I don't know if you have seen that in the solution, number of years.
Okay.
So the beginning of the question should be 2005, not 2004.
Oh, okay. Okay. All right.
That's why.
All right. Thank you.
All right. On Facebook, sorry, on YouTube, David Emerem is asking questions from every aspect of accounting. Yes. Do you have an ebook for public sector accounting and finance? Yes, we have ebook on public sector accounting and finance, but it is not accessible to the public. It's accessible only to our students who have enrolled in our courses. So David, yes, we have ebooks. You can get it on Amazon. You can get a Kindle version on Amazon, or you can get a hardcover here. But our ebooks are available to our students who have enrolled in our course in relation to that. So MRM, David, that is the answer to your question. Okay, so back on Zoom, who else has any question for me here on Zoom? Eric Aite. Okay, Ebenezer, your hand is still up. You can come. Ebenezer, your hand is up. You can come. Okay. Yeah, Jemima, you want to talk? You can go ahead. I see your mic is unmuted.
Yes, please. The convection, I didn't really get that side well, and I need to know the how to record it in the statement. So at the end of the period, you see the loan is converted into shares. So the rate, is there a rate different from that one, or?
Are you saying, is there a rate different from that one?
Yes, usually I've seen some effective rate and coupon rate, and I don't know which one.
Now, those things don't apply on the conversion. Now, the effective rate is used to calculate the interest rate when you are doing the subsequent measurement and you are carrying the asset at its amortized cost. Okay, you carry the, sorry, you are carrying the debt at its amortized cost. You use the effective rate to get the interest rate. Then the coupon rate is the annual interest payable on the debt. So you use the coupon rate for the annual installment. So let me show you a pro forma on how these rates are used. So 3 rates will be given to you as far as you are dealing with convertible loan notes. The first one is the interest rate of similar bonds without conversion. The second rate is the coupon rate of the loan note. And then the third rate is the effective rate of the loan note. So let me show you how we can use that in relation to answering the question in that case. So let me show you the pro forma from my notepad here. So this is the pro forma. On subsequent measurements, we're going to be bringing, among other things, the following. We will bring the year, and we will bring the balance brought forward. We will bring the interest. We will bring the payment. Then we will bring the carry forward. Now, this is where you got to be careful. The interest here, you'll be using the effective rate to get the interest. So here you bring the effective rate. Then the balance brought forward for the year 1 is always the fair value you had. If it is, once you separate between the debt and the component and deduct the issue cost, the figure you get is what you bring here. So you multiply that figure by the effective rate, and that gives you the interest. Now that interest goes to the income statement for the year 1. That is the finance cost that will go to the year 1. Then the payment or installment is what we will pay every year. So that one, use the coupon rate. The coupon rate is the interest rate payable on the loan note. And that is always less than the effective rate. Why? Because the debt has, how do we call it? A conversion inside, and the debt also it's a convertible loan note, what happens is that, and the issue cost that is involved, it increases the effective rate. So the effective rate is what we should have paid them, but the coupon rate is what we actually pay them. And Nuntina, the effective rate goes to the income statement as the interest expenses for the year, and then the coupon rate is what we pay every year to them. So at the end of the day, this is deducted. Okay, so this is the pro forma. So if I'm dealing with year one, we bring the balance brought forward, we charge our effective rate on the balance brought forward, we deduct the annual installment, and this gives us the closing balance. So that is the treatment. Are you okay, Jemima? Is this the question you were asking?
Yes, please.
Okay.
I'm okay.
All right. Okay, so let me see if we have any other questions coming from our YouTube channel as well. All right. So that is it about Jemima. Let me stop sharing my screen in relation to that. Yeah, Ebenezer, mic is on.
Yeah. I wonder if you can take me through the second question on impairment allocation.
In the book?
Yeah.
Okay, let's see. What did you say, page what? Okay, the second question. All right.
Yeah.
So AB Limited acquired a car business at the start of the year at $230,000 when the net asset of the car business was $190,000. So anytime we see a question like this, what happens is that there is goodwill, because if the fair value or how much we paid is $230,000, but the net asset of the business is $190,000, it means that there is a goodwill of the difference, which is the $40,000 in relation to that. So we see the net asset of the company. There is garage, there is computer, there is vehicle, there are intangible assets, cash, and then let's go to the additional information. On 1st February, the car business had 3 vehicles stolen. The net selling value of each asset was $10,000. Because of non-disclosure of certain risks to the insurance company, the vehicle were uninsured. So these vehicles were stolen. Their value was 10,000. So it means that when it comes to the vehicles there, we're going to be deducting that in relation to that. Then we come to the issue about also on 1st February, a rival taxi business commenced business in the same area. It is expected that the revenue of AB will be declined, leading to a fall in the value of the usage of the business, which is calculated at $140,000. Then it is unlikely that the business will be sold as a going concern. Then III, the net selling value of the taxi license has fallen to $25,000 as a result of the taxi operator. All right, so how do we go about this in relation to that? So let me share my screen here. So always what happens is that we will get the net asset before impairment, then we get impairment in the middle, then we get a net asset after impairment. So asset before impairment, then we'll bring impairment in the middle, and then we'll get the value after impairment. So these are the 3 columns we're going to be going with, and then certainly items will be here. So if we check if we check what is happening there, we'll realize that from the question given to us, we have garage. So we bring the garage there, it's 20. We bring computers, it is 10. We bring vehicle, that is 90. We give intangible assets, that is 30. We bring receivables, that is 50. Then we will get
the receivables.
Sorry,
The receivables is 10.
10, yeah.
50 is the cash.
It's 10. And then we get a cash of 10. Oh,
cash is 50.
I'm coming. Let me take my things a bit up so that I can get the amount right. So garage, computer, vehicle, intangible asset, receivables, cash, and then payables. So these are the things there. So let's see, garage 20. So this is before, okay? So garage is 20, computer is 10, vehicle is 90, intangible asset is 30, receivables 10, cash 50, and then payables 20. So the net assets before any impairment is treated as what? 190 in relation to that. Then we need to get a value at the end of the year. So if you realize, we were told in the question that from note 2, also on February 1, a rival taxi business commenced business in the same area. It is expected that the revenue of AB Limited will be declined, leading to a fall in the value of the usage of the business, which is calculated at 140,000. It means the recoverable amount of the business is now calculated at what? 140,000. That's the recoverable amount. Now, you know, an asset is said to impaired by comparing the fair value less cost to sell with the value in use. Now, in this question, we are not giving the value in use. For that reason, the amount in relation to that. So now at the end of the year, we carry the business at the recoverable amount, and that is the 140. That is the 140.
Okay.
Now, we subtract the 140 from the 90, and that will give us the impairment in the middle, and that's going to be $50. That's the impairment in the middle. That's the 50. Is it going to be 50?
Yeah.
No. I made a mistake. The value of the asset we bought is actually 230. Okay. So there has to be goodwill, which we build into the system. It is not in the question, but we will build it into the system, and the goodwill is going to be 40. So we will build that into the system. The goodwill is 40. We build it into the system so that we get 240 in relation to that. So when we subtract the 140 from the 230, that's going to give us an impairment of 90. So the question then is, how do we allocate impairment? There are 3 steps we follow in the allocation of impairment. Number 1, we allocate impairment first to the separately identified impaired assets. So in the question, we were told that 3 vehicles were stolen, so they were impaired, and the 3 vehicles were 10,000 each. So 10,000 times 3, that is going to give us 30,000. So straight up, when it comes to vehicles, we are going to be deducting 30 from there for the vehicle, because we are told that the car business had 3 vehicles stolen. So that is gone. Then another thing we were told is that the net selling value of the taxi license had fallen to 25,000. Now remember, the intangible asset is what represents the license. It was 30,000, but now we are told it has fallen to 25. It means it has suffered an impairment of how much? 5. And that will be brought up in the middle. So these are separately identifiable impaired assets. So they are stated in the question that they have impaired. So we deal with them in relation to that. Once we do that, we now write off goodwill. We write off goodwill. So step one, we write off separately identified impaired assets. Then step two, we now write off goodwill. Now, if we check, our total impairment is 90. So far, we've deducted only 35. So we are left with something like 55. So we can write off the entire goodwill of 40 in relation to that. So the goodwill 40 is going to go, so that at the end of the year, there will be nothing in relation to goodwill. Now, note that when it comes to dealing with impairment, receivables, cash, and payables usually are not subjected to any impairment in relation to that. So what we would do is that the receivables, we will just bring the 10 there. The cash, our cash value cannot reduce. Time value of money, that is not in accounting. And then we will also deal with the issue in relation to the payables in relation to that. So that will also not suffer any impairment. Now you realize that we will be left with garage and then the computers, the garage and the computers. So, and if you look at the workings so far, we've charged impairment of 75, but the total impairment was 90. So we'll be left with 15. So that 15 left will be allocated between what? The garage and then
computers.
So that is going to be, with the add the two up, that is 30. So it's going to be 20 here over the 30 times the 15 that is left. And that will give us the answer for the garage. Then we do 10 over 30, that will give us times 15, that will give us the answer for the computer. So when we deduct these two figures, I think if you do the workings, you will get 10 for garage and you get 5 for the computers. So once you are done with that, you will now be able to get, there is nothing on goodwill, but you will now get your garage figure should be 10 in the relation to that. And then you will also get your computers now to be 5. Your vehicle now it's going to be 60. So you add that up and that should give you the figure we have below here, 140 in relation to that. So that is a treatment.
Oh, okay. Okay.
So usually the principle is what you have to follow. The 3 core principles, how we allocate impairment. First step, you write off separately impaired assets or separately identified impaired assets. Number 2, you write off any goodwill. Now in the question, you will not be given the goodwill, but if you compare the net assets against the cash consideration, the difference will be the goodwill. You write off any goodwill, then any other amount of impairment left will be written off in relation to that. So that is the answer to that question.
Okay. All right. Thank you.
All right. Any other question? Eric Aite, I think I see you joining. So if you have any questions, you just notify, you lift your hands, you click on the left hand button, and then I'll let you come in and then you ask your question in relation to that. Let me see if we got some question on YouTube. Okay, no question from YouTube. All right. So for those of you who are on Zoom here, okay, Jemima, your hand is up. You can go.
Yes, please. With the evaluation in PSA.
Yeah.
Evaluation of financial statement. I think that's the ratios that we are used to in financial reporting. I want some small clarification about how things are carried on in that aspect.
Okay, in PSA.
Yes.
Okay, now in PSA, the interpretation of financial statement is different from what you do in the FR. It's different. They are not really the same. It's different because now you are dealing with the public sector, but there are a couple of ratios that you are going to be computing or there are a couple of indicators that are going to be using, or that you are going to be using to evaluate the performance or the financial performance and the financial position of the public sector entity. Now, there are numerous of them. I may just discuss a couple of them with you here in relation to that. So let me divide my screen sort of into two so I can do my things well. So one of the indicators that you will be using to assess the performance is something like debt to GDP. Debt to GDP. So that's going to be the total debt of the state, of the government, divided by the gross domestic product times 100. So that is one of the indicators. Now, what does this measure? This measures the proportion of our debt as compared to the GDP in relation to that. If you are a fan of listening to the public finance issues, one of the things that the finance minister says a lot, if people are saying Ghana is borrowing, they will tell you that yes, Ghana is borrowing, but our debt to GDP is falling, which means that really we are borrowing, but productivity is increasing. So if productivity is increasing, there is no P, there is no cause for alarm in relation to that. So that is the first indication, or that is one of the indications we will use to assess the financial performance and the financial position of the government on the consolidated fund. Another indicator that we can use could be GDP to GDP per capita. GDP per capita. Now, when we say per capita, it means that if we share the GDP among the population, how much will everybody get? That is the GDP per capita. So GDP per capita will be the gross domestic product divided by the population. So if Ghana's population is 30 million and our GDP is whatever, 300 billion Ghana cedis, you divide that with the 30 million population and you will get how much everybody will get in relation to that. Now, the higher the GDP per capita, the better it is for the state in relation to that. So that is also another indicator that we can compute. We can also compute debt per capita. Meaning, if we share the debt of Ghana, how much will everybody be paying? Or how much will everybody be owing? So the debt per capita will also be your total debt divided by the population. So if Ghana owes $240 billion and our population is 30 million, if we divide, how much will everybody be owing? Now, the higher the debt per capita, the worse it is for the state, because say the cabebre no be the cabebre, it will be a key issue for that in relation to that. So that is also another indicator that we could use in order to assess financial performance, financial position. Others that we could use in this bracket could also be in terms of our expenditure. So sometimes the government wants to assess of each of the expenditure item, what is the proportion of that to the total expenditure of the state? So for instance, we can do public debt to total expenditure. Sorry, public debt interest to total expenditure. So that way you bring your public debt interest over total expenditure times 100. So the government wants to find out the public debt interest we are paying. If we take it as a percentage of our total expenditure, how much is that? Now, the higher the public debt interest, the worse it is for the state. Preferably, it should be falling. But one thing is that if our debt is increasing, our interest liabilities is increasing also, then this is going to be in relation to that. But one thing you must understand is that, for instance, for the rest of 2020, the World Bank and IMF has actually frozen any interest and loan repayment for the rest of 2020 to Ghana, especially to Ghana, because we are in Ghana, due to the outbreak of the coronavirus. It means when you are assessing the performance of Ghana this year, the public debt interest as to the total expenditure is going to fall. Now, it is not falling because our debt is falling. As a matter of fact, our debt is actually increasing. It is falling because of the policy from the IMF in relation to that. So this is where your interpretation comes in. So you don't just get up and do the interpretation, but you do the interpretation in the context of your understanding of the various indicators that you are using. Another ratio we could use is personnel emoluments to total expenditure. Personnel emoluments to total expenditure. So personnel emolument as a percentage of total expenditure times 100. So government want to find out of the total emolument that we are paying, what is the percentage of that to the total expenditure? Now, the higher this ratio, the worse it is for the state. Because if, for instance, you are paying you are paying expenditure, and about 30 or 40% of your expenditure is used to pay just salaries, meaning less amount of money will be available to deal with other capital expenditure in relation to that. Now, with this government, now in my public sector class, I make some of these statements, but it is not political. So you make sure you understand. My students know that about that, but because we are in public or we are doing this as well on YouTube, let me clarify that. When I make a statement, it's not about a political statement. Now, this government especially has increased the number of people in the public sector, and you are all aware of it. So you realize that at the end of the year, there is a minister, there is a deputy minister, there is a deputy, there is an assistant. And so the total personnel emolument of the government as a percentage of its total expenditure may be increasing. Why? Because the government is employing more. Now, if that is happening, it means more money is being used on just personnel emolument, which is a current expenditure, and less amount of money is being spent on capital expenditure. So in order for us to get a better clarity of the expenditure, one of the things we can do is capital expenditure over total expenditure also times 100. Now, preferably, we will want this ratio to be increasing. Preferably, how much capital expenditure the government is spending every year should be increasing. But what happens usually is that it will be reducing, and the personnel emolument to total expenditure would rather be increasing. Now, if that happens, it means we are not putting in place any assets, we are not undertaking any capital expenditure, and that means that going into the future, that will affect various things and various aspects of the economy in relation to that. So these are a couple of the indicators. There are about 20 or 25 of them that we could use to assess the performance of the organization, of the state, but these are a couple of them. The key thing is that you know how to compute them and what they stand for and their interpretation. At this level, we don't say, the ratio has increased or decreased by from 20% to 10%. This is because the revenue of the company, no. You got to go deeper in public finance to be able to do your interpretation in relation to that. So Jemima, this is some of the things you must understand about that. Does it make sense? Grace, you want to ask a question?
Yes, sure. But can you hear me?
Yes, but just that your network is doing romantic sister.
But try and get what I'm
No. Grace, we still can't hear you. Your network is doing romantic sister.
Nhyira, what's the difference between that still?
Is that what's the difference between
receipt and payment, and also revenue and expenditure?
Okay. Now, the receipt and payment is the cash book in the public sector. So in the private sector, in financial reporting, we will say cash book. But for NGOs, public sector, we will say receipt and payment. Then the income or revenue and expenditure is like the income statement in the NGOs and the public sector. organization. So it's like the statement of financial performance or the income statement in relation to that. So receipt and payment is cash book. Revenue expenditure is an income statement.
Nhyira,
Yes.
the next question is in taxation.
Okay.
Companies are supposed to carry over losses.
Yeah.
I want you to explain that for me. You know, some companies are supposed to carry over losses in 3 years, and
Yes.
some are supposed to do that for 5 years.
Yes.
Kindly indicate those companies and also explain further.
Now, usually it's basically 3 years for most companies, but oil, mining, natural resources, those kind of companies traditionally are supposed to go for 5 years in relation to that. So usually companies are supposed to carry on the losses for 3 years, but the company can write to the Ministry of Finance and with permission from the sub-regulatory body that they belong. So if it's an insurance company, the National Insurance Commission. If it's a mining company, Ghana National Petroleum Company and the Petroleum Commission, I think so, something like that. You must write to those institutions with the Ministry of Finance, and an approval can be made. So even though traditionally you can carry on losses for 3 years, you may, by permission, be required to carry it for 5 years. But traditionally, many companies are supposed to do 3 years, but with further recommendation or writings to the Ministry of Finance, you may be required to carry it 5 years. But traditionally, mining, oil exploration, natural resources, those companies usually do 5 years in relation to that. Does it make sense?
Yeah.
Okay.
Nhyira,
Yes.
Regarding the receipt and
I cannot hear you. I
income
cannot.
statement, can
Grace,
you give me a format of that thing and explain? You cannot hear.
your network is
Hello.
your network is doing Roman sister. So
Can
it's
you
hard
hear
to
me?
hear. Yes, I think it's better now.
Hello, still.
Yeah, I think it's better now, so you can talk.
Okay, I'm hanging the phone in the air. Okay. I'm saying that regarding the expenditure, I want you to give me the format and also explain the items within that format for me.
The revenue and expenditure.
And also receipts and payments. The items and the rates.
Okay. So with the receipt and payments, like I said, it's like your cash book. For that reason, at the end of the day, all your receipts all the money you receive during the year will come in the receipt and payment in relation to that. So the tax revenues that you receive divided into direct taxes, indirect taxes, other non-tax revenues, fines, penalties, fees, forfeitures, all of that will come. Then grants that you have received during the year will come. Then whatever loans that you have received during the year. So any cash that you've actually received during the year comes in the receipts. Then the payment side, because it's also a cash book, all the payments you've made in terms of personal emolument, in terms of interest payment, in terms of personal emolument, interest payment, loan repayments. So all the payments that you've done during the year, cash payment, is brought to the payment side in relation to that. So the receipt and payment, you're just going to be having how much cash you actually received during the year, how much cash that actually went out during the year. But when it comes to the revenue and expenditure account, the revenue column, you are going to be bringing the revenue that was earned. So for instance, if the direct taxes at the end of the year, direct taxes outstanding that the government is supposed to receive that it has not been received, it's say 10,000, and the government has actually received like 5,000 in the trial balance. In the preparation of receipt and payment, the 5,000 in the trial balance is what will come to the receipt. But when we are preparing the revenue and expenditure accounts, under the revenue, we will bring both the actual receipt and then the outstanding amount. That is how we get the revenue figure there, because here we are preparing the income statement. For that reason, all revenue receivable for the year would have to be accounted for in relation to that. So we will still have our tax revenue, direct taxes, indirect taxes, grants, loan, and all of that. But we are not going to be bringing the actual cash we've received. We are not just going to be bringing the actual cash, but we are going to be bringing how much is outstanding, how much is due to be received will also be brought in relation to that. So that is the thing about the revenue. Then on the payment side, on the expenditure side, we are going to be bringing both the cash expenditure that we've paid as well as the outstanding expenditure. So for instance, employee emolument. During the year, we paid 200,000 Ghana cedis. That will come under the payment when we are dealing with the receipt and payment. But when we come to the revenue and expenditure account, that will come plus any outstanding employee emolument for the year under consideration. That will also be brought in relation to that. So the total expenditure of the government will come under the revenue and expenditure accounts in relation to that. Then loan repayment. Loan repayment will come in our payment, receipt and payment account, but it won't come in our expenditure account. It is only the interest on loan that will come there in relation to that. Then certainly capital consumption, that is depreciation, and all of those other items will come in relation to that. So that is the difference between the receipt and payment as well as the revenue and expenditure accounts.
Okay, thank you, Nhyira.
All right. Okay. So any other questions for me? Those, yeah, Jemima, you can go.
Yeah. Please, I want to know the difference between the IPSAS 2 cash flows and IAS
7
cash flows, like the presentation and any differences between maybe the items, maybe this one refers to this in this.
Okay, so let me see if I can share my pro forma with you here. Let's see. Public sector. Financial statement. Okay. I want to show you the pro forma here so that I go through with you because it's quite lengthy and cannot just, okay, it's not this one. So I guess it will be this one. All right, so let me share my screen with you and then you'll be able to see what's happening there. Okay, so this is the pro forma of the cash flow in IPSAS 2, that is the public sector organizations. So we bring the receipt and payment. So definitely it's the same thing, operating activities, investing activities, and financing activity. But you asked for the difference. So let me give you the difference of the bet. You realize that in public sector, in PSA, in FR, under the financing activities, we bring things such as issue of loan notes, issue of shares, repurchases of shares, and sometimes dividend payments. Usually in private sector, in the public sector, government doesn't issue shares. So under the financing activities in public sector, the only thing that usually comes there is the loan notes that we have received, issue of loan notes, and then the repayment of loan notes. So usually it's only about the loan notes that comes in the financing activity in public sector, because government doesn't issue any shares in relation to that. So let me go through the pro forma with you here. Under the operating activities, is just like the receipt and payment. Remember, you're dealing with a cash flow statement here. So you're going to be bringing only the cash that you have actually received during the year, and then the cash that you are supposed to or you are paying during the year in relation to that. So we're going to have our receipt, and that is going to be taxation. Here, tax revenue, direct taxes, indirect taxes, the actual ones that you've received during the year. Very, very important, okay? The actual ones you received during the year. Very, very important. So any tax outstanding doesn't come in, because you're dealing with cash inflows and cash outflow. Then sale of goods and services. Sometimes the government would sell goods and services, depending, maybe we are dealing with an MMDA or an MDA that charges for its services that will come. They will deposit some money in the bank or in an investment account. Any interest they receive on it will be brought there. Other receipts will be brought. Now, when we say other receipts here, it could be grants they've received and those items there. Then on the payment side, the usual things, employee cost, superannuation, what we pay to our suppliers, interest that we've paid during the year. Now, the loan repayment doesn't come here. It's not an operating activity. It rather goes in the financing activity. But the loan interest, the interest we pay on the loan notes or the loans that we've gone for, that will be brought here. Then any other payments, then that gives us the net cash and cash equivalent, or the net cash from operating activities in relation to that. Then we come to investing. Remember, like we did in financial reporting, the investment activities has to do with what? The purchases and sale of assets. Okay, purchases and sales of assets. Almost the same thing happens here in relation to that. So purchases of fixed assets is an outflow, proceeds from the sale. So if the government sells any public assets like Terminal 3 and the other ones that they are trying to sell, when the government sells all those things, it will become under investing activity in relation to that. It's an inflow. Then purchases of any foreign currency securities, then any other investment that the country has, we will treat it in relation to that. So that is also the investing activity. Then we look at the financing activity, and like I told you, we bring only the loan notes in relation to that. So basically, this is how we do the treatment when it comes to public sector cash flow statement in that case. The wordings are going to be different, and there may be some items that may not be here in relation to that. Jemima, you good? So that is the answer to your question.
Please, you made mention of the interest in the operating activities as an inflow. Which one is that one?
Like, for instance, the government has some deposits or short-term investment, and they receive interest on those deposits or short-term investments. That comes as a receipt here.
Oh, okay.
So usually this one, it's just interest on some short-term investments.
Oh, okay. And what of the differences in the financial assets? Is it operating or is under financing?
Differences in the financial assets.
Yes.
Yeah, that is more or less going to be on that's an investing thing. So it comes under investing activities.
Okay.
That comes under investing activities.
Okay, I'm good. Thank you.
All right. Okay, so I see some other people. Acca S1. Who is that? Can you hear me? If you have any questions, you can bring it up. Acca S1. All right, so that is it about that in relation to that. Let's see if I have some questions on YouTube. Okay, no questions on YouTube. No. Okay, so that is it about that. And Acca S1S, sorry. If you have any question, you can indicate and then we will take your question. If not to, then you can just keep listening to us in relation to that. Now, so I have provided you with a, give me a moment. Okay, dunamis. Right, so I've provided you with some the key areas you have to focus on various subjects and how you can study as well for various subjects in order for you to, so you make sure that you take note of these things very well. And one thing I will also advise on briefly is that don't put yourself in a haste to say that I'm going to be writing as much papers as possible. So if it is 2 papers you can work on those papers and work on them very well. If it is 3 papers you can work on these 3 papers, taking into consideration your schedules and everything in relation to that. So, and for those of you, in case you are watching and you have written a paper before and you perchance didn't go through, don't think that you just need a revision. Pretend as though you've not studied the subject before and start everything from scratch. Because if you think that, oh, I just need some revision, you may be relaxing and you may not do well again. So in case you have experienced anything like that, make sure that you pretend as though you've not done the thing before, have an open mind, and go through every single thing as though you are starting from scratch. When you have that juvenile mindset and that open mind, it will enable you to understand the thing better so that you can prepare well and most importantly, pass the exams in relation to that. So in addition to the issue about the key areas that I have provided you, that is also one thing I want you to look out for. If it is 2 papers you can work on those 2 papers and work on them very well in relation to that. Yeah, Jemima, your hand is up, you can talk.
Yes.
Yeah, Jemima, go ahead. Jemima, your network is dropping, so if you can start again.
Oh, okay. I was saying I want to know the difference between the revenue from contracts, transactions, and the foreign exchange transactions, yeah, and how it's recorded.
Relax. You want to know the difference between what?
Revenue from exchange transactions, that's IPSAS 9.
Yeah.
And I saw some other revenue from construction contracts or something. I don't know if it's FR or PSC, but I think it's PSC.
Okay. You got to understand this carefully. When it comes to public sector, are you asking the question from the context of PSA or from FR, so that I know how to approach it?
PSA.
PSA. Okay. So when it comes to PSA, there are two IPSAs that address revenue recognition. I don't have them off head. There are two IPSAs. One is revenue from exchange transaction. I think IPSAS 19 or so. Let me see if I can get that somewhere here in my slide. So there are two revenue recognition. One is from exchange transaction. One is from non-exchange transaction. Now, in a nutshell, exchange transactions are transactions where a party receives a consideration and does something in return. So for instance, issues such as revenue from goods, sale of goods and services is recognized under exchange transactions. Then we have non-exchange transaction where the entity receives the money but does not do anything in return. Something like cash, gift, something like donation. Those things are there. Then there is also foreign exchange transaction, and that one also I've forgotten the IPSAS name. This IPSAS, I don't know, I've not really kept them on myself. So there is an IPSAS that covers foreign exchange transaction, and that is where you are asking from. That is similar to the IAS 21. So the concept is this. Let me share my screen with you so that we go through it. Okay. So let me share my screen with you. Now, so when it comes to dealing with that aspect, what we do is that there is going to be like 3 exchange rates that will be given. Exchange rate at the date of the transaction. There's going to be exchange rate at the reporting date. And then there is also going to be what is called the weighted average exchange rate. Now, how do you do these treatments? Number one, for the initial recognition of the transaction, we use the exchange rate at the date of the what? Transaction. So for instance, government buys PPEs, that is personal protective equipment from China, $200,000. So in order for us to record that, maybe they bought it on credit. So in order for us to record that, we will use the exchange rate at the date of the transaction. Maybe it's 5.8 or it's $6. We will use that and get the initial recognition. Now, since they bought PPE, that is government stores. So what do we do? And it's on credit. What do we do in relation to that? We debit the government stores account with the value we will get from the workings using the exchange rate at the date of the transaction. And then we will credit the creditor's amount in the name of China or the company that we bought the goods from China. Then when it comes to subsequent measurement, the standard states that for financial assets, which are issues such as trade receivables, trade payables, and those things, for financial assets, they are translated to the statement of financial position using the reporting date. So the government store is a non-financial asset. So that one, we don't translate it using the closing rate. We still use the rate or the value at the date of the transaction, and we take it to the statement of financial position. That is, if at the end of the year, we've not used it. But for the creditors, which is a financial asset, we will translate it to the statement of financial position using the reporting date exchange rate. Then we are going to find a difference always between these two, and that is going to be exchange rate loss or exchange gain. That exchange rate loss or gain goes to the statement of financial performance for the year under consideration. It goes to the statement of financial performance, or if you want, the revenue and expenditure for the year under consideration in relation to that. So that is the treatment about the date and then the reporting date. Then sometimes the reporting date does not come in. Maybe we bought the goods in January and then we are paying for them in somewhere in August. So how do we deal with the issue? On January, when we bought the goods, we will use the date of acquisitions exchange rate. Now, at the date we are paying, we will use the exchange rate at the date we are paying. Then again, any loss, foreign exchange loss or gain will still be treated in the statement of financial performance for the organization in relation to that. Then we have the second aspect. So the first aspect is foreign transaction, and then the second aspect is foreign operations. So if we are bringing now all the embassies around the world, Ghana embassies around the world, they will prepare their financial statements, and we need to translate their financial statements into Ghana cedis so that we can prepare the consolidated financial statements. So if we are translating their results, what do? Now, their statement of financial performance, that is their income statement, we will translate it using the reporting rate. Sorry, the weighted average rate, very, very important. The weighted average rate to translate their income statement, and then their statement of financial position, we will use the reporting date rate to translate their financial position. So that is how we deal with the foreign operations and foreign transaction. Let me just cross-check this. It should be IPSAS 5. Let me see. Jemima, are you okay? Yeah, it's IPSAS 4. It's IPSAS 4. Effects of forex, effects of changes in foreign exchange rates. So it's IPSAS 4. So that is it about that in relation to that. Jemima, do you get a concept there?
Yes, I'm following and I appreciate it. But I would like an addition to, like, I mentioned construction contracts. I don't know if it's IFRS or IPSAS. So I hope you could help me.
If you don't know where it is, then you've committed an error now.
Really?
You have to know where it is so that we can contextualize it. Because
I'm very sure it's an IPSAS.
Because there is IPSAS 11, which is construction contract. And then there is also IFRS 15, which is revenue from contracts with customers. So you must know where you are standing, then we can deal with you.
Oh, I'm okay with IFRS 15. So I think maybe it's the IPSAS 11 that, if you could say something about that one.
Okay, with the IPSAS, so when it comes to IPSAS 11, the treatment actually is the same as the issue in relation to IAS 11, because we are looking at construction contract, and the recognition issues are almost the same thing in relation to that. But this is what happens in the public sector. Because we are looking at it from the perspective of the public sector entity, either being the contractor or the contractee. So usually what happens is that the government is going to be the contractee, but if the government can also be the contractor, which is actually the basic concept of what the IPSAS 11 is about. Sorry for the drop. So if we are dealing with the IPSAS 11, what happens is that, sorry, yes, the IPSAS 11 construction contract. What happens is that definitely we need to find out about the contract and find out about how we determine the contract revenue and all of those things. So for instance, we have to find out the first step. Let me pick my, whether we are making a profit or loss on the contract. That's the first step. So how do we determine that? We look at the contract revenue, and then we're going to be deducting the total contract cost, and that will give us either profit or loss in relation to that. Now, if we get loss, the entire loss has to be written off in the year under consideration, okay? Like in the current year under consideration. But where we made a profit, then we go to the step 2 and we have to calculate, or we have to allocate the profit and the revenue on the contract using the issue in relation to the percentage of completion. And with the percentage of completion, we can either use the input approach or the output approach. So if we calculate the percentage of completion, that will enable us to be able to look at how much revenue has to be charged, and that will be the percentage of completion computed times the contract revenue in relation to that. So that will give us the revenue allocated. Then for the profit figure that we get also, we're going to be using the percentage of completion we computed to get a profit that we will allocate for the year under consideration. Then certainly the balancing figure will become cost of sales in relation to that. The balancing figure becomes cost of sales in relation to that. So where the contract is having a profit, that is how we do the treatment in that case. Then at the end of the day, there has to be receivables, because there is going to be what is called work certified, WC. Now the work certified is how much work we've done so far, which is deemed to be completed. Now, so all the time, if we have done a work of say 100,000 Ghana cedis, the contractee or the customer will not give us all the 100,000. So the customer will retain some amount of money. So there is what is called cash retention. So we're going to be getting the work certified is the same as the invoice that we would take to the customer, but the customer will not pay us all that. So when we less the cash that we have received from the customer from the invoice or the work certified, that gives us what is called the receivables. And that goes under current assets in the statement of financial position in relation to that. Then the final aspect that we have to also look at is the issue in relation to the contract asset or contract liability that will be taken to the statement of financial position. So how do we deal with contract asset or contract liability? Simple. The pro forma is that we bring the cost incurred to date. So whatever cost we've incurred to date will be brought. Then we'll bring any recognized profit or loss. So recognized profit or loss will be brought. If it is a profit, we add it. If it is a loss, we will deduct it in relation to that. Then the work certified or the invoice we took to the customer will be taken out in relation to that. And this gives us the contract asset or the contract liability. If it is a positive figure, it will be a contract asset. If it is a negative figure, it will be a contract liability in relation to that. And that will be taken to the statement of financial position for the company under consideration. So Jemima, that is the concept about that. I see someone, Bernard Kwabena, Kobena, or whatever. Is it Kobena? Yeah, Bernard Kobena. If you have any questions, you can unmute your mic and then you can ask in relation to that. Jemima, I believe you are okay with that.
Yes, I am. Thank you very much.
Okay. All right. So that is basically the idea about that. So make sure you take note of the key areas that I've provided. And also, like I said, spend time to study, spend time to work on yourself, spend time to practice as much questions as possible. When I say practice as much questions as possible, I don't mean go and download the ICA past questions and be solving them. That's not the only thing, okay? That's not the only thing, especially with the new syllables, the exam structure and everything is going to be different, mostly for most of the subjects as compared to the old syllabus. So get some questions outside the ICA past questions, get a question bank of ICA, and then solve some questions there. Get some ACCA questions as well and practice in relation to that for the subjects that are in ACCA, like financial management, financial reporting, and those kind of other subjects, management accounting and those other subjects. You can do that in relation to that. So basically, these are the things that you must understand. And I'm going to be concluding our discussion for today here. And we're going to be having another session as well tomorrow, I think around 10 a.m. or the details of that meeting will be posted as well on our various platforms so that you will be able to join in relation to that. Grace, did you want to say anything?
No.
Okay.
I wanted to say bye-bye.
Oh, okay. All right, so that is it for today. Jemima, I believe that it was a fruitful discussion, and tomorrow, God willing, we will be continuing.
Nhyira?
Yeah.
Nhyira, Jemima is my daughter.
Oh, really?
Yes.
I didn't know. I didn't know.
I've been speaking about it to her, so she decided to join.
Okay. Yesterday.
Jemima. Yeah.
She's on mute.
You said?
She has muted her mic.
So she will come. She even called me to remind me that she come online. She's in.
Yes. I'd wanted to tell him, but I wanted to keep it a secret. I didn't want to tell him you were the one who told me. I see he is very good.
Oh, it's a lot of people can learn something.
Yeah, he's very good. And I like the way he's doing the
okay.
question and answers.
Thank you very much. So, God willing, tomorrow, 10 a.m.
Okay, enjoy your day.
Okay, Grace, bye-bye. So, God willing, tomorrow we'll continue with the discussion, and I'll see you same time tomorrow. So, you take care and stay safe.